What's all the hype on leveraged ETFs, and should you invest? In recent years, the popularity of leveraged ETFs has increased along with other riskier trades like zero DTE options, altcoins, and NFTs and the like. In theory, leveraged ETFs are designed to provide a multiple of a return of other standard investment products like the S&P 500, the NASDAQ, gold, bonds, and anything else. A question that I commonly get is that, well, if I know the market's going to return 10% on average, why not just buy a leveraged ETF that tracks the market but can amplify my return so that now I'm returning 20 or 30% a year on average? This question sounds nice in theory, but if we look at the actual long-term performance of these leveraged ETFs, we're going to find a very interesting phenomenon that we should look closer to. Over the short term, which is roughly 3 months or less, these leveraged ETFs actually deliver exactly what they market: a return that's exactly a multiple of what the standard ETF delivers. However, when we start to look at the longer term, namely over several years, we find that the exactness of these leveraged ETFs starts to erode. Let's take a look at one of the more popular leveraged ETFs, TQQQ, and compare it to the standard ETF, QQQ, which it tends to emulate. Both of these ETFs will track the NASDAQ 100 index, which is an amalgamation of large tech stocks in the United States. QQQ will follow the NASDAQ 100 to a T, whereas TQQQ will amplify the returns by 3, meaning that if the NASDAQ or QQQ goes up by 1%, TQQQ will go up by 3%. Now, looking back to January 1st of 2020, we'll see that QQQ returned a whopping 146%. Now, looking at that return, you would think that TQQQ should return somewhere in the neighborhood of 400% over the same time period. But what we actually find is that the leveraged ETF only returned 231% over the same time period. Although that is still an outperformance, it's definitely not 3 times the amount that it was promised to be. And remember, with these leveraged ETFs, you are taking 3 times the risk on a day-to-day basis. Looking at the COVID crash as the most obvious example, we're going to see that the NASDAQ ETF, QQQ, dropped by roughly 25% in the month of February and March of 2020. However, looking at TQQQ, that investment dropped by 70% in the same time period. Regardless of what kind of investor you are, seeing your investment drop by 70% is a lot harder to hold than seeing a 25% drop. So in short, if you want to invest in the short term to capitalize on short-term market volatility, leverage ETFs are a good way to do that. But if you want to invest for the long term, stay away from these products and just invest in something a little bit more simple.